Yeah.
I said no, but I guess at some point
It's exclusive.
You want to jump right in?
Oh yeah, we ready to rock?
It's rolling, yeah.
All right, what's up? My name is Matt Baker. My company is me and my partner Kevin Wood. He works at Google in the Silicon Valley. Kind of our system is we find small multifamilies in the Houston area, and we put them under contract, and then we utilize the investor money that he's created, or the channels he's created from his job and his network up in Silicon Valley, to where they are able to invest in Houston, which with much more favorable returns. This is WoodBaker LLC. Here's my contact info. So what I'm going to start with, I'm just going to go over one thing today, and then we just do a general Q&A. Is I'm going to go over how I very quickly analyze small multifamilies and then make offers on them. Because I mean, kind of what he's talking about, a lot of people struggle, like a lot of people are interested in small multifamily, but they struggle with, they'll see a high price, they'll get scared by it, or maybe it's too much. If you haven't analyzed enough deals, you won't know exactly what you're looking for. So does anyone know the cap rate formula? Because that's the basis of how we analyze multifamilies.
Yeah.
Anyone? What is it?
It's the net operating income divided by 10%. If it's a 10 cap, gives you the...
Nothing in Houston's a 10 cap.
Right.
So we'll just say the cap rate.
Yes,
NOI,
cap,
right, over cap rate.
NOI over cap rate.
NOI over cap rate equals price, right? Pretty simple.
So Matt, if you
Yes.
write kind of big, that Texas Realty Club.
That's how big you want me
That's
writing?
about perfect, yeah.
Okay, here we go.
There's an eraser too on the table.
Nope.
Don't tell him.
That's all right. When we fill it up, we can get that done, right? Price. Okay. So I'll see places all the time, and like you were talking about earlier, we've got huge issues with owners just not knowing what their property's worth.
Yeah.
We're just trying to milk the market because Houston is like insanely hot right now. And so what my strategy is I throw all of their numbers out the window because they're lies, or they're missing stuff, or they're just lying themselves. Like a lot of people, they manage their own properties, so they don't put property management, and that blows a deal up, right? If you're making a deal on their expenses, but you need a property manager, the deal doesn't work anymore, right? Now it's a negative deal. So I just throw all that out the window, right? So how I got my NOI, a very quick way is, you just look at what they're renting their units for. So let's say it's a 10 unit, okay? And they're renting them for $500 a month, okay? So that gets you gross, gross is 5,000, and then for the year you'd be 60,000, okay? So that's your gross rents. Now a lot of people at this step, to get to their NOI, they will take this crazy spreadsheet and they've got their assumptions and they're like having to input and stuff. If you're going through all of that, you're not going to get your offer accepted, right? Because by the time you finish your spreadsheet, there you already have the offer accepted, it's done, right? So what me and Kevin do is we just say, okay, 40% expense ratio. Can someone do 60 times 0.4 for me?
So
24,000?
24,000.
Okay, good. So there's our 60,000, that's gross rents, minus 24,000 equals 36,000, right? So this is math I do like on site, right? You can already see their rent roll. Sometimes they're going to give you a pro forma, and you just got to take everything with a grain of salt. There's a lot of incomplete information here, but yeah. So there's your 36,000. There's your NOI, right? And then you've got your cap rate. So cap rate this is why you got to look at a lot of properties, because if you aren't familiar with the area, you might say, oh, okay, I've been looking at properties and they're in a 6 cap. Like I look a lot in the Heights, Rice Village, Edo, like really hot markets. They're 6 cap, maybe even sub 6 cap, right? But we just offer at 6 cap in those areas, and then we go from there. But if you're at a place like, I just looked at a property in South Houston, right? You need to understand that, okay, this is a little like lower class area. I know that this is like an 8.5 cap, right? So that's something that's driven by, if you have an agent, your agent should know that, and kind of filter that through your own knowledge as well, because sometimes the agent will just tell you whatever you want to hear, so you got to be aware of that. So we've got our hypothetical property. Let's say it's in the Heights, right? So we've got 36,000, and we've got divided by 0.06. Okay, so what's that?
Calculator time.
Yeah.
By the way, do you mind if we ask questions while you're going through this?
Yeah, no, interrupt me, absolutely.
So, on your properties, have you found that the 40% expense ratio is
It's a little conservative.
conservative? Okay.
It's a little conservative. Why? Do you have higher expense ratio than that?
So I did, but that was back when I was underwriting a lot bigger properties.
Okay.
And there was actual.
But the bigger property should have a smaller expense ratio, I would think. I've never
Well,
owned
you
a-
end up adding in more expenses with actual salaries and stuff. So
Yeah.
you're going in
That does make sense, yeah.
the lower units. So.
Yeah, and this 40%
It's
for
something
us,
I've always
it
been
catches
confused with.
vacancy, it catches property management, it catches basically everything. I think we are operating our small multis at 37%.
Okay,
So, yeah.
and that's why I was asking because I don't have as much experience dealing with 20 to 50 unit
Right.
range, and I don't know where that lands. I know mobile home parks supposedly land around 30.
Oh, okay.
The bigger stuff is I would call more around 50ish, but I don't know where this lands.
Okay, yeah, and that's something I'll have to learn as well once a week. We're trying to move into that 60 plus where you actually have the on-site person, yada yada, but that hasn't happened
It's
yet.
good information.
No, it's really good. Yeah, so that's actually kind of a weird advantage of a small multi. If you find the right property management company,
Yeah.
WoodBaker LLC, you can operate possibly a small multifamily at a better ratio than you could at a large one. So that's interesting. I never heard that.
So you said 37% average.
I think that's what our numbers are.
What kind of spread do you have? Is it a pretty tight spread?
What do you mean spread?
Are some of your properties 50 and some 30, or is it more like?
No, I think it's pretty good. So what we do is we find properties that are high value add.
Mhm.
So what'll happen is we'll get this big capex budget at the beginning of the property, 180 grand or something. And we'll spend all that. So that may be pushing our maintenance costs down because we've fixed everything up, and so there's nothing left to repair.
Gotcha.
So it's unclear. We'll have to wait 3-5 years or whatever, but. Here I am now giving this presentation. But this has been pretty effective for us, and we've noticed it gets us pretty damn close to it's a really competitive offer. It's always 50,000 under what they were asking, and that's just part of the game, right?
Mm-hmm.
Does that include any capex setback or set asides or?
So let's cover that in a second. Okay. So this would be right, because the books say you're supposed to offer on the actuals, right? You don't offer on what it could be worth, you offer on what it is worth. So did anyone do this math? What would this number come out to?
No, it was 600,000.
200,000.
It's 600,000? Okay, I'm sorry. It was just such a round number, I didn't know this right. Okay, so that's 600,000, right? So you got a 10 unit, 600,000 in the Heights. That's pretty good. 60,000 a door just off the back of the napkin, that's good. There's a 0% chance this property is listed in the Heights at 600,000, right? But you'll see properties like this all the time, running for half of the market. It's just, so this property has most likely never been updated, needs a ton of work, right? So let's say they're at 900K. This would probably be 90 to 100 a unit is about right in the Heights, Edo, Rice Village. So they might be asking 900, right? And so obviously we've got a big deal. So here's where we've got to do some investigation, right? So my NOI is based on my formula, gross rents and expense ratio. We just keep that expense ratio at 40%. We don't touch that. So, but what we will see is, okay, if we put enough money into this thing, what can the rents be? And this is again where some experience comes into play. So we look at Rent-A-Meter as kind of a general overview. And we've got Rent-A-Meter Pro, which is it's $10 a month or something. So you should definitely do that if you're interested in buying small multis, because it allows you to quickly, I could go look at a property, go look at one unit and take their word for this is how all the units look, and then go to my truck and just go okay, this is this much per unit to repair, this is this much unit to repair. And I can have a damn near accurate, I can have a very competitive price ready, and then, because what I need to do is I need to take the after repair rents and then plug it into my NOI formula. So let's say I know that in the Heights, $990 for a 1-bedroom, I can do that basically all day, right? So if we say 1,000 times 10, that's 10,000 gross rents per month, 120,000 per year. What's that times 0.6 or 0.4?
72.
72 is a 0.6? Is that right?
Yeah.
72 is okay. So that makes our NOI approximately 72,000. All right, divided by 0.06. Someone calculate that, please.
It's 1.2.
1.2 million? Okay. So there's 1.2 million, right? So this is what it's worth now, this is what it could be worth, this is what they're asking, right? And the only missing thing is, like you said, the CapEx. So unfortunately, it's hard for even me to come up with a quick CapEx. I'm trying to make like a spreadsheet that has like, because I know, we've been like seeing some properties trying to get some contracting going, but it's tough for me. I've realized from working with you that like, I can't do a quote before you have it under contracting, right? Because it'd be just too much, right? Yeah. But what I'm trying to do is I'm trying to make like a Google Drive, like a Google Word doc that's like, okay, look for the top 10 items, right? The top highest repairs, and like, this is this much per square foot. This is this much per door, right? And then I could give you that tool and you could come up with a rough estimate. And then once you have it under contract, we could like smooth it out. So I'm trying to do something like that. But for this example, we'll just say like 20,000 a unit. That's probably about accurate for like a height style property that needs like more or less a full gut. Let's say this thing's 1940s, you know, you're gonna need that, right? So that would put our CapEx of this at 200,000. And then you're just kind of analyzing what your return requirements are. So, you know, you're not gonna give them 900 because that's just crazy, right? But you know, you could probably give them more than 600. You could probably give them like 750, all right, let's do that down here. 750,000, right? And then a 200 CapEx. So you're 950 in. That's your price that you're all in on, and you're 1.2 million. So what are you making on that? 300K? Someone do 750 times 0.25? And just for like, so I'm trying to estimate like a cash on cash return for this.
187.
187
plus 200.
Yeah. Okay. So 387.
Yeah, 387.5.
Okay. So that would be, I mean, that's starting to approach like we like to get like 100% equity return on like small like on major rehabs like this, where it's like, because there's a lot of risk on a $200,000 rehab that this turns into a $250,000, $300,000 rehab, right? So you better make sure you have a lot of cushion in it, and you don't want to pay the owner for the pleasure of rehabbing his property, and then, oh look, at the end of the day, I just paid him exactly what it's worth, and you went through all of this trouble just to do that.
So would you say 100% return on what the cash you put into the deal?
I would say return on equity, yeah, or return on capital. Okay. I think about 100%. That might be a little aggressive, but you know, I mean, you could definitely go down on that if you wanted to. But I think that right now in the market, you can get 100% on your equity, like on major rehab, on major value adds like this. Yeah. And so that's basically my whole system.
Are you? Oh, sorry.
Go ahead.
Are you getting this stuff off MLS?
Well, we've like made relationships with several brokers, and we've got a person that does the MLS stuff for us. So we'll look at stuff off the MLS all the time. I mean, and I'm getting deals, I don't know, quote unquote, accepted a lot. You know, that last one I talked about, what was it, last month? That fell through because it was a $500,000 repair budget.
Was that the Rice Village one?
No, Rice Village is still under rehab. That's actually coming along quite nicely. No, this was at Edo.
The Edo. That's
the
right.
Edo one, yeah. I went in, I looked at it, and it was just like galvanized plumbing, and there was like a 200 amp service for a 9-unit building, and I was like, oh my gosh, what is this? So, yeah, that didn't work out too nicely. But I just do this, I mean, because once you start doing this all the time, I mean, I just go to my truck and do it, call my partner, say, okay, here's what this is, it's gonna be this, you know, what can we get on rents? He tells me that, I'm like, okay, plug it in real quick on my calculator, and then we're ready to make an offer that day. We always make offers that same day. And we get a lot of properties under contract for that reason. Like, I mean, we literally got one under contract today.
Nice.
Yeah. And so that one's like an 8.5 cap in a D class, but we're like, 8.5 cap. We'll pretty much take anything in an 8.5 cap.
Right. So the reason I was asking is I have seen, for the ones that I'm looking at on market, typically with a broker involved, they're starting, at least now, I don't know if this is typical or not, or if this is a kind of like the nature of the market right now, but they're starting to basically offer things not at a cap rate, but at like a return on capital.
I've never seen that.
I've seen it a couple times. So basically what they're saying is the value add is priced in.
Don't just throw that out the window.
I didn't know if that's something you ever ran into.
Well, I mean, I don't know, because I don't even look at the sheet. I just go look at it, run this formula, and then and we don't offer, like, let's say, like, you know, we see, like, oh, it's worth 650, or like the most we can buy it for is like this, right? Like, let's say 750 is my number, right? I don't go in there and offer 750. Like, I'll offer like 650, you know, or whatever. Mm-hmm. Like, we pick a number that's like really palatable to them. Like, let's say like it's worth 630 or something, right?
Yeah.
And I'd really like my first offer to be like 570, 580 or something like that.
Mm-hmm.
But I know 600 looks a lot better. And I know that I'm a lot less likely to get blown out if I use 600 as an offer rather than 590. So I go up 600, right? And you know, we do like manipulations like this a lot. Like kind of like with rent, we never do 1,000 a month. It's 990, right?
Yeah, that makes sense.
Like doing things like that. It's like there's a book written about it, Predictably Irrational, that covers like all of this stuff, right? Mm-hmm. And so we just utilize a lot of those tactics, a lot of negotiation tactics to get the price that we want.
Cool.
Yeah. All right, I mean, yeah, that's really all I have to present for now. And so if you want to ask me any questions, please go ahead.
How did you and Kevin meet?
We went to high school together.
Oh, really?
Yeah, we went to Clearbrook.
Really?
Yeah.
Oh, cool.
Go 01, class of 01.
Nice.
Yeah.
What kind of volume do you try to get on your deals? Like just in deal flow in general?
It's all.
All of them?
Yeah.
That's not a bad answer, really.
Yeah. Well, because we almost have, like, we have a unique situation where we like have a lot of capital,
Mm-hmm.
right? We have more capital than we have deals. So it's just like, really the limiting factor is our time,
Mm-hmm.
which we're trying to work on. So we need to, you know, like sometimes we'll get like we got one under contract today that we had seen last week.
Mm-hmm.
And then I just looked at one today that we have another offer in on, like we're gonna put in tomorrow.
Okay.
So it's like, you know, it can get a little crazy. We seem to get 2 deals at once all the time.
Mm-hmm.
Like the last ones we did was in the U of H area. We got a 12 unit and 10 unit in like 2 weeks apart.
Okay.
And so just doing the due diligence and like the inspections and stuff, like on those types of things are stressful.
Yeah, I can believe it.
Where's your capital coming from?
Investors that Kevin meets out in California.
Okay, so you have a group of investors and y'all just.
It's not really an official, it's not like our group, you know, it's just like he meets with people all the time. Like that's kind of what he does for the business, in addition to, you know, like doing accounting and stuff. But he, like he finds people and he sells them on our deals.
Okay.
And yeah, and you know, for them, it's a great deal because you don't have to do anything. We do everything. And it's much better than anything they get in the San Francisco market.
And how do you structure each deal? Is it like an individual LLC or partnership? Or
Yeah. We do. Well, for a while, it depends. Like we have one investor who he has a lot of capital, and so we just have like that one LLC owns several properties, like 5 properties.
Mm-hmm.
But we decided to kind of go away from that, and so now we're going to like each property is its own LLC.
Okay. And then are you invested in each deal also? Or
Yeah, we have an equity share.
Okay.
Yeah. So like, well, what we were doing is we were doing 50-50 deals where they front all the cash for the property and the repairs,
Mm-hmm.
and then we would do all the work, and then we would use the cash flows from the property to pay them back, right? So the cash on cash return was really good for them because it all front loaded all the cash to them. But unfortunately, that kind of like stressed us out on cash, so we have to like go into a different deal structure, like a 2 and 20. I don't know if you're familiar with that for syndication. 2 and 20 is like 2% acquisition fee.
Mm-hmm.
So like let's say like this one of these properties, it's like 650K or so that we're looking at. Like if we did that on a 2 and 20, then we would get 2% up front, so 13K, and then we get 20% of the equity just right off the top.
Okay.
And then like you would offer them some sort of preferred return, like, oh, okay, look, like you give me 20% of the equity, but I'll guarantee you at least 7% on your money, right? So if it's ever, you know, the split ever makes it to where they would make less than 7%, you don't get anything,
Mm-hmm.
but you know, then you would get everything on top.
Okay.
Do you typically have multiple investors per deal, or is it one?
Yeah, we like to,
Yeah.
because like I said, we have a lot of investors that like, now that we kind of have a reputation, especially in that area, like with those groups that they're running in, like people want to invest with us, right? And so we found that it's a good way to kind of show people what we're about. Like, so let's say I need 100K in capital, right? I can get one guy for 100K, and that'd be great, right? Or if I get 5 people at 20K, then it shows 5 different people like what we're about, and then it shows them how we run our process, and like, you know, I'm updating them all the time with the contracting and the rehab and yada yada, and then they get comfortable with us. It's kind of like a repeat sales type of strategy where, like, oh, once you've done business with someone once, it's much easier to do business with them again, and it's a lot more palatable for someone to be like, especially, you know, if you're like have like 500K to invest, you're like, oh, I'm just going to invest 20K here. If it doesn't work out, whatever. But if it does work out, or if I like the way they were doing it, then next time we have 80 unit, you know, and we need to raise 1 million, 2 million, or whatever, then it's a lot easier to go to that person and be like, hey, I want 150K. Can you do that?
So are you constrained then on unit size? Like, do you have because the supply is limited, right? I mean, they're not like building a ton of
Right.
B to C class stuff, obviously. So do you try to focus on like 20 to 30, or do you just go for anything that you could find?
Just anything with a value add. I mean, I think our biggest is 12. I don't know why we always land on 12. But I think maybe because they can list that on the MLS, maybe there's just a lot more transparency there.
Mhm.
I want to do bigger because I mean, there's just more money. You know,
Yeah, I
like if
agree.
you do the math, like it's just like, oh, times 20 is better than times
Right.
10. But I don't know because that's the commercial brokers and a lot of people are looking right now.
Yeah.
I want to get into development because I'm like, this hot market is just crazy right now. So I want to start building multifamilies. So
Smaller ones or?
whatever. Yeah, I mean, you have to be smaller to start. Like I
Yeah.
can't start with a 150 unit.
Yeah, that's what you're saying.
Do you know John Frazier?
No.
So he's from Clearbrook. I met him last week, and he's actually developing in the 3rd and 5th wards.
Really?
And he's just buying land and building duplexes and triplexes on them.
Oh, cool. I might have to get that contact info from you. Yeah, that'd be good to know.
So what about time frame for each deal? Do you put a time frame where you're gonna sell or cash out the investors, or they're just like indefinite?
Yeah, basically indefinite. I mean, we kind of I like the Warren Buffett model. Well, especially in the areas we're buying in, like it'd be foolish to sell, right? It's like we have a property that's 1 block from Rice University and 1 block from Medical Center. Like
Mhm.
that is never going to depreciate. Like
Right.
it's the safest investment you can have. Like why would you sell that?
So if an investor wants their money back, then what? Like 5 years from now?
They can't get it.
Okay.
Like I mean, because that's not in our contract. You know, it's not like
Gotcha.
oh, whenever you want.
You don't
it.
have like a buyout provision?
No, there's no buyout provision, yeah.
Okay.
And I mean, and I'm sure that as we grow, like apparently that's something that is required. Like, okay, a 5-year hold, a 7-year hold, a 10-year
Yeah.
hold, like that's very common. But I mean, I don't like it and I don't see why investors demand it.
Yeah.
Because I mean, frankly, the buy and hold is much more effective for long-term equity and stuff like it. The long-term wealth is in buy and hold, I think. I don't ever want to sell anything. Even in this hot market, because it's like, we have a property we can sell for like a massive gain, but I'm like, what are we gonna do with that money? You know, like, I mean, we're finding stuff, but it's not as good as the one we're gonna sell. And like, you know, you're finding it these inflated numbers, and it's like, okay, we could sell it and keep the cash, and then what? Hold it for 2 years until the market slows down? Like, that's not rational.
So as you grow like your syndicate pool of people, I guess, have you had to deal with the SEC and like accredited investors?
No,
that kind of thing yet?
because these are all personal relationships, so that like circumvents the SEC requirement.
Okay.
But as we like when we do a syndication for an apartment complex, I think that's going to change. I think that I can't remember, like I don't know if there's a unit size component or what. It's more
There's like
Kevin's
a bunch
bag.
of exclusions. I've been trying to figure it out. I didn't know if you'd ever made any.
And I don't know, and
confusing.
it
I'll
might
be
be
honest,
one of those
I'm
things that
confused by
we're in
it.
violation of the law, and we just like we're just so small that like no one
Well,
notices.
you are,
it.
everybody is, because I've been asking everybody and no one really knows.
Oh yeah.
Yeah.
Well, I mean, Kevin, my partner, and if you want to email me if you want that
Yeah.
information, he has, like, so we're getting coaching from a syndication guy. Like
Okay.
he does like syndications all over the country. Like that's his model.
Yeah.
Like he doesn't do, like we do more like a full, like we do the property management, we do the contracting, and we only stay in Houston. His strategy is I only do one type of syndication, like a C class to B class value add, 1980 or newer, pitched roofs, not flat roofs, no chillers. Like he has all these criteria,
But he
and,
does
and he does it
everything.
all over the country, right? So he just outsources everything.
That's kind of
And that's an interesting strategy as well.
Who is that?
Andrew Cushman.
Why does that name sound really familiar? Is he famous?
That's not
I
familiar.
don't think he's that famous. I'm not sure.
I thought you were gonna say Joe Fairless.
I'm not. No, I've never.
No.
Was he on a Bigger Pockets podcast?
Andrew Cushman.
Cushman?
I think he was
I
actually.
think he was.
Yeah.
Hey, what's
Sounds
quite his
familiar.
name sounds familiar.
So Kevin is in. He's
Yeah,
in.
Kevin.
He was on the Bigger Pockets
Yeah.
podcast. But he and Andrew are in this like M1 group. It's like this like wealth building group.
Okay.
And then like so like they'll meet weekly and like have these accountability calls and like they'll talk about what they're doing and you've got like there's a lot of real estate but there's also a lot of like entrepreneurs and things like that. So like they kind of give each other advice
Mhm.
and that's where he met him.
Okay.
Cool.
For your properties, are you looking to refinance at any point?
Yes.
Yeah.
Yeah, I mean really what we want to do is if anyone's not familiar, there's the Fannie Mae loan, which is just devastating. So right now on these like this range is like actually like no man's land really, and this might be why we're able to get them at such high value adds, because like investors like they want to get the Fannie Mae and the Freddie Mac loans, which are like $1 million or greater loan balances, but you have to meet all these criteria where it's like, okay, 90% or more occupied, or like, and you have to have such and such for CapEx, and like, I don't know the requirements, but there's requirements, but it's a 30-year amortization commercial loan, right? This is just through Allegiance Bank, so I have a 20-year, 25% down recourse loan, so it's not ideal. So what we want to do is we want to value add up into the Fannie Mae range, refi with a Fannie Mae at 30-year, because at 30-year, we'd be like, our returns would be like, it'd be like really good.
So I'm kind of dealing with some of that now as I'm trying to navigate all this stuff, and some of the bigger brokers will actually allow you. They'll give you like a not very favorable loan and let you do the value add on a loan.
Mhm.
Have you guys ever done?
Are you talking about a
anything
bridge
like
loan?
that? Basically a bridge loan.
Okay.
Yeah.
We've never done it, no.
I think in the small, I don't know if they call it a bridge loan for like smaller stuff or not, but there might be another term for it. But it's ultimately a bridge loan. They'll give it to you at like 7%.
Okay.
You'll have 2 years, and then you get a balloon payment, and then when you get the balloon payment, you refi.
Okay.
And most of the time, what I've noticed is I think it's interest only for those 2 years.
Okay, so we kind of have a similar one on one of the value adds we're doing, where basically like we said, here's what it's going to cost to buy the property, here's what our rehab budget is, add those two together, we give you 25% of that up front, and then they give us bank draws as we complete repairs.
Okay.
So, and I totally messed up the bank draw like schedule, so it was like really devastating, but that was a lesson learned.
Yeah.
Front load the bank draw.
I got you. Cool.
So if somebody wants to start doing what you're doing right now, but they don't know anybody that can capitalize for them, can fund the deals, do you have any suggestions for them as to how to go about finding those people?
Yeah, what I would do, if I didn't have any money, I would wholesale these deals. I would get them under contract at their correct price. So I actually, I wasted a bunch of time like looking at a few deals over the past few weeks with this guy, and he's got a great business model, so good for him. But he'll find these multifamily properties, he'll get them under contract, and he'll wholesale them, right? But when he wholesales them, he doesn't like he email blasts, but then he schedules one showing, and like 15 investors show up, and then everyone wants the property, and it creates this huge competition for this property. It's a genius strategy.
That is nice.
However, the prices are always like wildly inflated, and I'm always like $200,000 under the offer price that ends up winning, and I'm like, well, I'm not doing that. So yeah,
That's working for the seller though.
that's what I would do. What's
Yeah.
up?
That works for the seller though, even though you don't get it. He's getting an extra $200,000.
Oh, no. It doesn't work for the seller because the wholesaler's getting the
Yeah,
200K,
wholesaler.
not the seller.
Oh.
Or whatever his fee is, but I'm sure the fee is like ridiculous. I mean, if you think about a fee on a house, it's like 10K maybe. I mean, these guys got to be making 50 grand a deal.
Yeah.
I would guess, you know. Especially the prices they're listing them at. I walked the property, it was a full gut, and it was going to be worth, it was pretty similar to this property actually. It was a 7-unit, but it was in Montrose, like the heart of Montrose. It was an awesome location, so I really wanted it. And they wanted $900 for it, and it was totally vacant, full gut job, and and it was like, I guess, a $300K rehab budget. And so that would have, and then we guessed that it would be worth $1.2 million after we're done with the rehab. And we're like, well, 900 plus 300K is 1.2 million. So this is a horrible deal. And I think we offered 600 on it, and they ended up getting an offer for 895.
Wow.
Yeah, so so those guys are doing all right. So that's what I would do if I did not have any money and I wanted to get into this.
Another question I've had, so the way you're underwriting this then is you really have like 2 levers to pull on. You have the expenses, you have the rents. You're keeping the expenses constant, and you have a history to prove that that's pretty accurate.
Yeah.
Have you ever run into situations where you miscalculated the rents, at least significantly enough it's going to damage you? Because
No. Okay. I mean, because we property manage ourselves, and we're just like really good at getting high rents.
Okay.
So like we always just do good at that. We have messed up on houses before about what we could get on rents, and I'm not sure. It was houses out in Katy, and they like narrowly avoided the flood, but for some reason the rents dropped like $100 a month based on what we had evaluated, and so we don't know whether. So Kevin evaluated that, so I'm on his ass about it.
Yeah.
But like we couldn't determine whether he had just miscalculated in the first place, or if he had actually, or if the storm had kind of spooked people off that area.
Right.
Which I mean doesn't really make sense to me, but I don't know.
Seems like rents would have gone up, right? 'Cause people.
I agree, it seems like rents would have gone up.
Something.
But I mean, I don't know, it's tough because Katy is also like kind of like one of those pocket like areas where it's like, oh, this neighborhood's kind of shady. Not shady, but just like the lower class neighborhood, and then you've got the neighborhood next to it, and they're renting for $2,000 a month for a house.
Right.
So
Makes sense.
we were definitely in one of the lower neighborhoods, so I don't know what it affected that.
It's interesting.
So do you still do houses right now, or just multi?
No, just multi. We're gonna get into some flips, I think, like partner with some investors on flips just to get some extra cash flow, just some consistent cash flow. But we have no. I just don't like. Man, I'll tell you what, those closing costs, like that was hard for me to swallow on houses. I was wholesaling last year, and and I talked to Robin about it kind of all the time, and we got all these houses, and we got one to do seller financing. Have you ever done a seller financing deal?
No.
Okay, do you know what that is?
I know what it is, yeah.
Okay, good. So, I mean, on paper, that is like the best deal in the world,
Yeah.
right? And it's still a great deal, don't get me wrong. If you can seller finance, that's what I would do with single family. I would seller finance them.
Okay.
We've got a seller finance deal where we like kind of wrapped the original seller. So we got ours at like 3.5% interest at like, I don't know, 120K or something. And then we sold it for 189 at 9.9% interest, and we put like 20 into it. So that was pretty juicy. I think we net like, I don't know, 800 a month on that or something.
Okay.
Yeah, so that's what I would do with single families, because I mean, just the headaches and the repairs and stuff, like it totally kills your profit. You're like you're making like 200 a month, you know, and then like net at best, if you're good at it.
Right.
And then like, oh, your roof blew out, that's 5 years of profit. I'm like, oh my gosh.
Right.
All right, that's all I got. I thought it was gonna be more material.
No, that's good, I
No,
mean,
that's good. But I'll keep answering questions as long as you got them.
How many units do you have under management right now?
Well, so under management is, I don't know, 60 or 70. But our personal, like that we have equity interest in, is 46.
Okay.
So yeah, and hopefully, yeah, that goes up to 8 plus 8, maybe another plus 7 too.
Yeah.
Yeah, that'd be good. But you know, this is happening all the time. We get deals like, and it's funny because like, I'll think we'll have a deal under contract because the seller like via email agreed to it, and then like when it gets time to submit the contract, all of a sudden some mystery offer came out of the woodworks, and they always do this. This happened literally today. We had our offer in, they said they're going to accept, and they're like, oh well, they got another offer, so we're going to need you to put your highest and best offer in, and we're like, we already did that, and we'll walk. We don't really care. And then like 2 hours later, they're like, they decided to go for your offer because it was a stronger offer. I'm like, all right, bro. I mean, that happens like all the time. I mean, like I probably like 80% of the properties we do, we have to go through that game, you know.
Yeah.
So don't fall for that game. Just walk away. If they have a higher offer, it is what it is, you know. But don't negotiate against yourself.
When you look at the rents there, have you had an issue where they're lying about what they're receiving?
I don't really care what they're receiving
So
that much.
it's basically
I know I look at this and give me like a baseline. That would be my original number, right? You're right, based on the actual rent. Yeah, people lie about it all the time, or like kinda like,
Yeah.
but like you have to get the rent roll, right? And so once you get the rent roll, like we don't really care that much because really we're in it for the value add, right? That's our main moneymaker. We don't care about the current rent. And so it's really good for you if they're lying on their rent roll, because what happens is when you go to verify the rents via estoppel, I don't know how to pronounce it. Do you know what I'm talking about?
Nah.
Okay, estoppel, I think is how it's pronounced. Does anyone know what I'm talking about? Is that how you say it?
I believe so.
Okay. Estoppel is basically your agent will go, and they will collect like written documents from all of the tenants, and they'll say, is this what you're paying for rent? Is this what your deposit is, right? And you get all that verified before the closing. So if the estoppel comes back and it's much less than their rent roll, that's great news, because you're like, hey, you lied on paper, you're gonna discount this or I'm gonna sue you. Now, usually it doesn't come to that. You're just like, hey, you misrepresented your rents, we're gonna have to knock down the price X amount for that, you know, and then that's as far as it goes.
So if you're going for value add, are you thinking about locations then with a lower cap,
Yeah.
I would assume?
Yeah,
the light is terrible.
it's not
Yeah,
ideal.
it sounds like it's gonna let you.
Yeah, that's why we like the lower cap, because the value add's more extreme.
Okay.
And especially, it seems like there's all these areas in Houston where it's like, the value add's never like C to B. It's always like D to A.
Yeah.
So, I mean, you know, obviously the numbers can be very favorable for us when we're doing a deal like that, especially when we're going like in the Heights or Montrose or whatever, from they're under rented by $300 a month and we go to not only market, but we're doing Airbnb on it. So
Right.
it's just like, the money is like really, really good. So I'd highly recommend
Oh
it.
yeah, I
It's
didn't
in a
even
high
think
cap.
about that. Yeah.
Yeah, it's
Has
like,
that been a lucrative thing?
yeah,
for you?
really lucrative. I'm probably plus 50% rent on Airbnb.
Really?
Yeah, it's like that high. No, I mean, but like out here, maybe not, I don't know. I would definitely try it.
I called bullshit on someone in Galveston for that because they were they came back to me and said I basically put in an original offer. They were giving me some of their numbers with their normal rents. It was like $750 a month. And they came back to me after we had discussed kind of a price and said, well, actually now I'm Airbnb in a couple units. Now my income's skyrocketed. To me, they actually were making, according to them, on a short-term basis, about 50% more on the units they were talking about.
Mhm.
I just didn't think there was enough history there for me to really know.
Well,
if that
it doesn't
was
matter.
true.
There's
And
not
honestly,
for
I
you.
wasn't.
There's not enough for the banks.
Yeah.
You got to get a loan on this
Yeah.
thing, and I'll tell you, the banks don't like the Airbnbs.
Really?
So we're actually in the middle of trying to refi a property. So we're looking for, like, we're Airbnb it in the meantime to get more money, but we're trying to get like a 6-month plus, because that's the bank requirement. So we get a 6-month plus renter in there at a furnished apartment, because a furnished apartment still rents for more than a regular apartment, right? So as long as we get them in there for 6 months, when we get like 3 months into that lease, we're like, hey, look, here's our financials, please refi us. And then once the refi is done, who cares? You know, we can do whatever you want with it.
Cool.
What's your turnaround time typical from closing to refi?
I don't know, we haven't refi property yet.
Fair
Well, I
enough.
mean, I just started like 3 years ago.
Well, just to get it, I guess, up to where you want it. I mean, what have you seen?
Well, so, again, I mean, there was a lot of learning curve. When, you know, like on our first property, like it was with our own money, not investor money. So we were very limited in our speed, right? I mean, because ideally what you do is you kick everyone out, you rehab them all at the same time, and you're done in 6 months. That'd be great. But, you know, we couldn't do that, so we had to go like, it was a 12 unit, it was like the front 2. Okay, now these 2. Okay, and then we're talking like, okay, it's like 3 or 4 months, but when you're rehabbing these to the level that we're doing. And then so it's like 4 months here, 4 months here, 4 months here, and all of a sudden it's like, man, it's been a year, and then I had to like pull my handyman off to do this other rehab so that we would make the investor happy. So on that one we didn't go as fast as we liked. But you know, every property we get a lot better at rehabbing, a lot better at our systems and stuff. So I've got one that's coming along real nicely. About 8 months I think is going to be the total turnaround on it. And it was like major like foundation, adding central air where there wasn't, so we've got to get the ducting in there and like build fur downs for it and things like that. So it's a pretty intricate project, and it's going relatively smoothly.
What software y'all using to calculate how much y'all can get for Airbnb? Like Airbnb or?
What is it? There's one, it's, they do the pricing and they charge you like 1% or something of what you make. For beyond pricing or something like that. I don't know, Kevin handles the Airbnb stuff, so that's not really my game. I just get them furnished and get them fixed.
So you said a foundation issue and like adding AC and that kind of thing. Is there anything where you look at a place and you're just like, this is way bigger than you want to take on? Are there any deal breakers, or is everything?
There's no deal breakers.
Okay.
For us, you know, and for some people there are. So we'll see. I think there's actually less risk in a project like that because, like, what else is going to break?
Yeah.
Like, I've already accounted for everything. Now, on that project, I didn't really account for it correctly, so I was a little short, but it was a lot less short than some of my other ones, so it was manageable. And especially, like, because, like, I didn't know how much replacing 2 4-ton HVACs plus ducting was off the top of my head. And I just couldn't get a guy out there to quote me, so I was, like, short on that one.
But even, like, major structural issues and stuff like that, you're...
As long as you can build them into the price.
Yeah.
You know, and especially like foundation's actually a lot less scary to me now after I did this project. So what it was a pier and beam, like with a concrete footer. So the concrete footer was basically level, like 1 inch difference maybe throughout the property. But then the middle literally sunk by 5 inches.
Okay, yeah.
And so it was like, you walk in and it's one of those properties where you're like, that's not level. Like,
Yeah.
it's not even close. Like, what is this?
Right.
And like the door, like, you know, it's supposed to be a 45 and instead it's like out like this and a giant gap. I'm like,
I mean, he showed me one like that, and then there was a garage apartment, but the whole like floor of the garage apartment was just caved in. It was like you could
was it
see
2511 Whitney?
Where?
Was it Whitney in Montrose?
No,
Oh,
it was in East End.
It was what?
Just a single family.
Okay, gotcha.
Yeah.
It's in East
Yeah.
End.
I don't.
No,
I
that
mean,
was a duplex.
Oh, that's right. I wasn't-
Duplex
sorry.
and a garage apartment.
Yeah, yeah.
The
Yeah.
middle was or the outside?
The middle was like.
Oh
came
yeah,
in
that's,
nice.
and it's a slab foundation.
I think so.
I don't know. It must not be.
Okay.
It was like, I don't know.
It's not too much to fix. Like
It was old.
like pure beam is easy to fix. Like I mean, now this was
it was
like
brick all the way down to the ground, but I don't know what the foundation.
They're like crawl
was.
space openings.
oh yeah, that's pure beam.
Yeah.
So yeah, those aren't very expensive to fix. I bet that property would cost like $4,000 to fix that foundation.
Oh, really?
It would be my guess, you know, like off the top of my head. Because like this was like a big, like 2-story, 1,700 square feet, like basically outline, like 1,700, 1,700.
Yeah.
So a pretty big property, and also the underneath, like so the reason it was dipping like that is because they didn't have like support beams underneath the load-bearing walls. They just
Okay.
had joists. So and it'd been like 80 years since anyone
Right.
had done anything with this, and that cost like $13K.
Okay.
So I mean, and I'm like that's pretty much the only like one I would avoid is a dip in the middle of a slab foundation.
Okay.
Because you're just gonna have to you're gonna have to tunnel underneath it, build the piers underneath. Like you don't need to deal with that. There's not gonna be enough meat in a single family house to account for like a $25,000 foundation. Like,
Right.
So during the rehab portion, the investors aren't getting any return
No.
for their money, so they're
Yeah, that's pretty standard.
They're good. Okay.
Yeah, we give them like we'll give them a timeline. Be like, look, here's what we're doing. But I mean, for it's like if the cash doesn't start coming until 2 months or 3 months, like after even let's say like that's a horrible example. Let's say it was supposed to be 7 months, but due to some issues, it was like 9 months. The cash flow's still there, so it's like really not that big of a deal. The deal is, can you get the rent you promised? That's what we care about. And I think that through trying to rush a rehab job, I've been burned in the past by, not burned, but just like, it's more painful than it needs to be. And I think that it's like one of those situations where slow is fast.
Yeah. Do you have a construction background? Is that how you know all this stuff?
No, I learned it the super hard way of just like bullshitting around, like not knowing at all what I was doing. Because the problem was we tried to get this 1920s place, the first multifamily we bought, we tried to get contractors in there because that's what you're supposed to do. And at that time, I still had a full-time job, and Kevin had a full-time job, so we had more money than time, so we were like, okay, we'll just sub this out. And we were getting crazy quotes, like $35,000 labor. And we're like, per unit, this is a 300 square foot studio apartment. I was like, we're not doing that. And then we finally went with one guy who was like, all right, he's gonna fix a few of our problems for like $8,000, which in hindsight is just like, totally ripped us off. You could just tell we were green, which is unfortunate that guys are like that, but he screwed us over. And like, so he only had like one sub working for him, one carpenter, like fixing the joists in this second story apartment. And the guy was like working really late, and we found out later he was buying coke off of another tenant in the apartment.
Wow.
So he was just working all through the hours of the night.
Kept him productive though.
Yeah. So after that guy, we just said, all right, we're done with this guy. We don't want to deal with this guy anymore. And then I just started doing it myself, which is like very stressful.
Yeah.
That's why I started a construction company or a contracting company for investors, is because I was like, this should not be this hard, right? It should be so much easier to, I mean, every contracting company you call should be competitive with, like, it should be like good customer service. They show up on time. They do what they're gonna say, but none of those things happen. So yeah, that's what we're trying to do.
So how much of that are you doing for things that aren't part of your own deals? Are you doing?
Well, we're trying to grow that. I mean, that's why I've been trying to work with him, trying to work with other investors. I mean, I actually just hired someone underneath me to help with the planning and scheduling.
Okay.
Because but that is mostly internal.
Mm-hmm.
We'll do a lot of make-readies and stuff, but we're not quite, we're just kind of trying word of mouth, going to
Okay.
meetups like this, trying to grow the business that way.
Yeah.
And then, eventually we'll get into some real marketing and stuff.
Okay.
So you've mentioned the rehab, property management, and then your investments in multifamily.
Mm-hmm.
What all else is WoodBaker?
No, that's it.
That's it.
Investing, contracting, property management.
Okay.
Yeah, we were trying to do more before, and we were just getting pulled in like 5 different directions.
Oh, yeah.
I think every investor kind of makes that mistake because there's so much opportunity.
I'm constantly distilling down my business
Yeah.
to like the bare bones minimum.
Yeah, go deep, right? Is what
Yeah.
they say. I think that's a good strategy.
Margin wise,
Things that make you money.
margin wise, what would you say is the biggest?
It's easy to
What's
carry away.
comparable to a normal contractor versus an investor-friendly contractor?
Well, so I didn't realize this before I started, right? Because what we were trying to do is we're going to do contracting for everyone. So we got like a lot of cheap contractors, because that's what we wanted for our thing, for our investments, because you know, it's like, okay, look, there's a little divot here or there, like little imperfections, like who cares, it's rental, it's fine. It had to meet a certain standard, of course, right, it couldn't be just crap, but we didn't need the guy that had the highest finish level, because those guys were more expensive. So we started accumulating subcontractors like that, and we were doing very well at it. And then I reached out and I was doing homeowners, and that was just a disaster, because they just need a certain level of finish that my group couldn't provide. So basically what I've done is created a group of subcontractors that are priced perfectly for an investor, you know, because like you're not gonna get the same finish level for a homeowner that you would for an investment. And that's fine, you know, you're not living in it. So that's basically what we offer. And I'm shocked actually that there's like so few companies that do this. There's like one, Fast Track Remodeling.
Fast Track, yeah.
Does anyone work with them?
I've
Or
talked to
heard
them, I
of
get a
them?
quote, yeah.
How was it? How was the quote?
I never got it.
Oh,
And,
really?
yeah, this was
So not
the same house we've been talking about on Blackhawk even.
Okay.
Yeah, the guy that I talked to, I can only imagine, like I've talked to the guys that go down to the Wealth Club and do the, you know, they stand there at the booth and
Yeah.
and they seem to know what they're talking about. The one of the founders went up and spoke in front of the group and he
Oh,
seemed,
Fast Track?
yeah, he
Okay.
seemed knowledgeable enough and all that, but this guy was a sales guy. I don't know how quickly they're growing as a business. He didn't seem to be as in tune with what they did.
Okay.
This was me and you talking to that guy. Remember this guy? That's right. It was Wandering Trail. It wasn't Black Hawk. It was a different house. And yeah, it was a pretty awkward conversation, to be honest with you. Not to knock them. I'm sure
he
that
just
they
had
do.
a kid, so he was like, I guess delirious or some shit.
He sounded a little delirious. Yeah, I'm gonna give him we'll give him a mulligan on it. 'Cause it sounded like not his daily self. So.
Okay.
So I haven't worked with them, but there's an agent in our office that did a flip with them and seemed pleased. I mean, you kind of just hand them the keys and they take care of it.
Yeah.
What I've heard is they're kind of 20% more than what you could get, or
really?
cost-wise,
Okay.
if you hired subs or something.
Well,
It's
that
more
sounds about
expensive.
right. I mean, that's like a typical markup.
Yeah.
Right? And because on paper, hiring the subs yourself sounds like the grandest plan there is, right?
Yeah,
And then you start
yeah.
doing it, and you're like, this is the
terrible.
worst experience of my life.
Oh yeah. It's not
I mean, just
coordinated.
finding subs is a full-time job.
Yeah.
You know, I mean, we spend hours on the phone just calling new subs, churning through guys. This guy this guy didn't even show up. We had a guy that he's like, oh yeah, I'm the man in installing doors. I'm gonna install all these doors for you, blah, blah, blah. And I'm like, and I just go and put a level on it. I'm like, dude, this is not plumb level square. Like, what are you doing? He's like, oh, my bad, man, my bad. I'm like, how did you not check this before I inspected it? And then we give these guys another chance, and they go paint this apartment, and they were having to buy tools on my Home Depot account to subtract the final. I'm like, you clearly don't do this work often because you're having to buy painting equipment. So yeah, that's the kind of things you deal with. Like the guy that works with me, he almost got in a fight with it was a father-son combo, and he almost got in a fight with the son.
We were just dealing with a contractor, and they told us a little bit about them. They have, according to them, the second biggest house in Galveston County.
Okay.
So I don't know if y'all are familiar with Tuscan Lakes, but if you go down Tuscan Lakes Boulevard, it's that massive white house.